Marcus opens his investment account on a Tuesday afternoon. He expects nothing new. Instead, he sees just over $20,000 sitting there. It makes him feel worse, not better. 3 years of $500 a month, $18,000 of his own money. The number in front of him is barely 2,600 more than that. 3 years and the market has barely shown up. 3 years ago, he and his friend Theo made a deal. Same day, same amount, $500 a month into the same kind of fund. No stock picking, no crypto, just the boring thing everyone says to do. Marcus picks up his phone and calls Theo. He mostly just wants to hear he isn't the only one wondering if this is working. Theo goes quiet for a second. Then he says he stopped a while back. I just got tired of putting money in and not seeing anything happen, he says. So he pulled back. He told himself he would restart later when things felt more stable. Marcus sits with that for a moment. He feels exactly what Theo just described. The temptation to agree is right there. Maybe they both got this wrong. Instead, he tells Theo he is going to keep going at least a while longer. He does not sound entirely convinced when he says it. He says it anyway. One of them has $20,000 in an account. Most of it is his own money, but it's real. The other one has whatever was left from a single year of contributing and a promise to restart someday. Here is the uncomfortable truth. Right now, you are either about to become Marcus or you are already becoming Theo. And you may not even know which one yet. And the part almost nobody tells you is that most people quit right before their account starts growing faster than they could ever contribute on their own. Not because the strategy failed, because it looked like it was failing right up until the second it stopped. Theo just lived out a very common mistake. Vanguard tracked $100,000 invested in the market since 1988. Left alone, it grew to almost $5 million. Missed just 10 of the market's best days out of thousands, and that number gets cut by more than half. Not because of a crash, not because of a bad investment, because of a handful of missed days. Theo's mistake was different, but it came from the same dangerous instinct, stepping back because the market did not appear to be rewarding him yet. That kind of loss isn't random. It has nothing to do with being smart. It comes down to 4 specific numbers. Know them and you can predict who ends up like Marcus and who ends up like Theo. Today, I'm going to show you those 4 numbers. People call it the 9751 rule. Stay until the 4th number. Most investors never use it, and it's the one that changes the ending the most. Theo did nothing wrong. He just hit a point where the numbers stopped keeping pace with his effort, and he quietly took that as proof it wasn't working. This is not about willpower. It is about a specific moment most people never see coming. Call it the invisible finish line, the point where the reward is closest and still completely out of sight. Most people don't quit at the start when quitting is expected. They quit right here. Think about water heating on a stove. For a long stretch, nothing visible happens. The temperature climbs the whole time, degree by degree. But to the eye, the pot just sits there, looking like plain water. Then, without warning, it boils. The heat did not suddenly increase in that final second. It had been building the whole time. An investment account works the same way. It is not failing during the quiet years. It is heating. Now, here are the 4 numbers. The first number is 9%. Here's why this matters more than anything else in this video. The first number that lodges in your head becomes your baseline. It doesn't matter if that number was ever real. Left alone, your brain will grab a number from somewhere, a headline, a friend's best year, a lucky quarter. Then reality shows up smaller. And it feels like proof something is broken. Nothing is broken. You just trusted a number that was never really yours to trust. Since 1926, the S&P 500 has compounded at close to 9% a year, dividends included. That's the number this video is built on. After inflation, your real spending power grows closer to 6%. Inflation quietly eats away at your money, whether you notice it or not. But 9% before inflation is what we'll use for every calculation ahead. 9% is an average. It is not a promise for whatever year you happen to be standing in. The market fell 37% in 2008. It dropped close to 20% in 2022. Land in a year like either of those, and 9% will feel like something someone made up. So here's why it holds up. Look at 10-year stretches in market history going back to 1928. 93% of them ended positive. Stretch that to 20 years, and essentially all of them do. The average doesn't show up every single year. It shows up once enough good years, and bad years even each other out. Set your number at 9, not 12, not 15. 9. A modest number you actually stick with will always beat an exciting number you quietly abandon the first time it disappoints you. Please do not misunderstand this. 9% is not a ceiling. Some years beat it by a wide margin. The market was up over 31% in 2019. It was up close to 29% in 2021. Years like that happen. They feel incredible when they do. The point is not to expect less from your investing. The point is to stop building your plan around years that won't repeat often enough to count on. Quick reminder, if you want help finding the gaps in your own plan, that is exactly what this channel is for. Subscribe if that's useful. But knowing the real number is only step one. The real test is whether you can survive long enough to actually collect it. That brings in the second number. The second number is 7. 7 years. That's the minimum amount of time you need to stay invested before you're allowed to decide whether this is working. Not 5 years, not 3. 7 at minimum before you judge anything. Let's go back to Marcus. Same $500 a month, same 9% average return. Year 1, he's put in $6,000 and his balance is about $6,250. Year 3, the point where he called Theo, he's put in $18,000 and his balance is about $20,000. Year 5, he's put in $30,000 and his balance is about $37,700. Year 7, he's put in $42,000 and his balance is about $58,200. 7 years does not mark the crossover yet. It marks the point where compounding has become too significant to dismiss as nothing, not just a round number. Of that $58,200, $16,200 is money Marcus never personally put in. Compounding now makes up almost 28% of his balance. In year 1, that share was only about 4%. That's exactly why Theo felt like nothing was happening when he quit. Most of what was in his account back then was still just his own money. If you have not started yet, this is exactly why today matters more than the amount you start with. Marcus did not need a large sum. He needed 7 years of not stopping. Start now, and year 7 arrives whether you feel ready for it or not. But suppose Marcus does not stop. By year 8, he's put in $6,000. Same as every year, the market adds $5,715. Close, but still behind him. Then year 9 arrives. For the first time, the order flips. He puts in the same $6,000, but the market adds $6,814, over $800 more than he contributed, without him doing anything differently. Call it the invisible finish line, the point where the reward is closest, still completely out of sight to anyone who already walked away. Whatever you're contributing right now, this same flip is coming for you too, and the gap only grows from there. By year 15, his balance is around $189,000. By year 20, around $334,000. By year 30, it crosses $915,000. None of this required a bigger paycheck or a smarter strategy. It required exactly what it required back at year 7, not stopping. If you are feeling tired, like nothing is working, this is what is actually happening. It's like pushing a small ball of snow down a hill. The more it rolls, the more snow it gathers, and the bigger it becomes. Eventually, it's a giant snowball that looks nothing like the small one you started with. What happened to Theo doesn't look like failure from the outside. It's often more discouraging than an actual loss. At least a loss gives you something to react to. In investing circles, this is sometimes called the rule of 7. It shows up in financial advice for exactly the reason you just watched play out. Theo left the game in year 1. He never got close enough to see what Marcus is looking at now. The third number is 5. It stands for 5 layers of diversification. Most people quietly get this wrong without ever realizing it. They think owning a handful of stocks counts as diversification, or splitting money across a few different apps. It does not. That is not diversification. That is just a collection. Real diversification means holding pieces that react differently to the same event. A bad day for one barely touches another. It has nothing to do with how many things you own. It has everything to do with not tying your entire financial life to a single outcome. Here's what each of the five actually contributes. Layer one is broad market index funds. The base everything else sits on top of. A single S&P 500 fund hands you partial ownership in hundreds of companies at once, a spread no individual stock picker could match by hand. It's historically delivered around 9 to 10% a year. For most people, it should anchor the portfolio, somewhere between 40 and 50% of the total. Layer 2, dividend income. Certain companies pay you cash simply for holding their shares, on top of whatever the price does. Roughly 1/3 of the market's total return over the last century has come from this cash stream alone. Not price movement. It's easy to overlook since it arrives quietly. But it keeps compounding through stretches when the price chart looks like it's going nowhere. A reasonable slice here is 15 to 20%. This is not a theoretical menu. This is literally what is sitting inside Marcus's account right now, quietly doing his job while he does nothing else. Layer 3, small and mid-sized companies with strong growth potential. These carry more risk and more potential reward. Within the broader small company category, value stocks have historically returned somewhere around 14% a year since 1926, compared to about 10% for the broad market. On paper, that gap looks small. Over 30 years on a $10,000 investment, that gap turns into roughly $180,000 versus well over $500,000. But here's the honest part most people leave out. That premium doesn't show up every year or even every decade. From 2010 through 2024, large companies actually beat small companies by close to 4 percentage points a year. The long-term edge is real. The short-term reliability is not. Keep this layer smaller, somewhere around 10 to 15%, and expect it to disappoint you for stretches before it pays you back. Layer 4, everything outside the U.S. American companies now make up somewhere around 60 to 65% of global stock market value. If every dollar you hold is American, you're still walking past roughly 1/3 of the world's investable companies. Foreign markets frequently zig when U.S. markets zag. They hold steady during stretches when American stocks struggle. 10 to 15% here plants a flag outside any one country's economic weather. Layer 5, the safety net. Bonds, treasury bills, cash, none of these make you wealthy alone. Their job is to sit still while everything else moves. If stocks drop 30%, a solid bond position might only drop 3%. That difference matters more than it sounds. When part of your money is still standing, you're less likely to panic and sell everything else at the worst possible moment. And panic selling during a crash is the single most expensive mistake in investing. A reasonable starting point here is 10 to 15%, though the right amount shifts with age. Lighter in your 20s and 30s, heavier as retirement nears. Some of you are already thinking, why not just put everything into layer 1, the S&P 500, and skip the rest? Fair question. It genuinely is one of the best single choices available. The problem isn't that layer 1 performs badly most of the time. It's what happens in the rare stretch when it does. Layer 1 alone has no backup for those years. The other 4 exist for exactly the years when it underperforms. There's also a second reason this matters, and it has almost nothing to do with returns. One of the strongest predictors of panic selling isn't how volatile the market is. It's how often someone checks their account during a volatile stretch. A portfolio spread across 5 layers is simply less interesting to check daily, since no single headline can move all 5 at once. That boredom isn't a side effect. It's the entire point. And even when you do check, seeing one layer down while another holds steady feels completely different from seeing a single number that only ever falls. One looks like a portfolio adjusting, the other looks like a crisis. Check daily, and an ordinary dip feels urgent enough to sell over. Check quarterly, and the same portfolio just looks calm enough to leave alone. Less checking means less panic, and less panic means you actually stay invested long enough for the 9% and the 7 years to do their job. Now, you must understand that diversification does not exist to make you rich faster. It exists to keep you in the game long enough for the 9% and the 7 years to actually pay off. A portfolio spread across these 5 layers moves less violently than one crammed into a single idea. And less violent movement means fewer moments where panic talks you into a decision you cannot undo. This is the number I told you to wait for, the one that changes the ending the most. The fourth number is 1. One increase every single year of about 5% to your monthly contribution. It looks like the smallest of the 4. It ends up moving the final number more than any of the others. Here's why almost nobody actually does this, even though it costs nothing to set up. Behavioral economists call it status quo bias, our tendency to stick with whatever default is running, even when changing it would obviously help, because a decision takes energy. There's real research here. In the early 2000s, economists Richard Thaler and Shlomo Benartzi built a program called Save More Tomorrow. Employees committed in advance to automatically raising their contribution every time they got a raise. Nothing had to be decided in the moment. Over 4 years, participants' savings rates nearly quadrupled, from 3.5% of their pay to almost 14%. The mechanism wasn't willpower. It was removing the moment willpower would have been required. Go back to Marcus, still at $500 a month, flat, for 35 years. By the time he is 65, his account reaches almost $1.5 million. Now add the one adjustment, increase his contribution 5% every year. Year 2, $525 a month. Year 3, about $551. Year 4, around $579. $25 more is one fewer takeout order. $50 more barely registers against a paycheck. By year 20, that one small habit pushes Marcus's account from roughly $334,000 to about $479,000, a difference of close to $145,000 created by an adjustment small enough to not even feel like sacrifice. By year 35, the gap is no longer small. Flat contributions land him at close to $1.5 million. The 5% habit lands him at just over $2.5 million. Over $1 million of difference. From a decision so minor, most people would not think to schedule it. This mirrors how life actually works. Income rarely stays flat for 35 years. Raises happen, debt gets paid off. Redirect even a slice of that extra income into the investment instead of a nicer lifestyle. And the compounding already running gets a second engine attached to it. The math on this one is almost unfair. It's the cheapest of the 4 numbers to apply, and the one most people skip, simply because nobody reminds them to do it. So if the math is this clear, why do so few investors actually reach the other side of it? Dalbar has spent more than 3 decades measuring exactly this gap. Their answer points away from strategy entirely. It points at behavior. In 2024, the S&P 500 returned just over 25%, a genuinely remarkable year. The average equity investor that same year walked away with only about 16.5%, one of the widest gaps of the past decade. The market didn't fail these investors. Their own timing did. Selling during a scare, buying back in once the rally had already run. Stretch the window to 20 years and it's not a one-year fluke. The market returned about 10.33% annually. What investors actually captured was 9.25%, a gap that looks trivial until compounding gets involved. $100,000 at the market's pace grows to roughly $717,000 over those 20 years. Compounded at what investors actually captured, the same $100,000 only reaches around $586,000, over $130,000 gone, not to a crash, to timing. There is a more recent twist worth knowing. In 2025, that gap narrowed sharply, down to less than 1 percentage point. one of the smallest on record. It shows the gap can close, but not because investors got smarter overnight. It shows that the behavior gap can vary sharply from one year to another, but one unusually narrow year does not erase the longer-term pattern. Dalbar has found that three patterns show up again and again in this data. The first is loss aversion. The pain of a drop feels roughly twice as intense as the pleasure of an equal rise. It pushes people to sell during the exact months they should sit still. Second is recency bias. A recent flat stretch gets treated as the new normal, even when decades of history say otherwise. And finally, there's herding. People move their money because everyone around them is moving theirs. That's how withdrawals cluster right before a rally, the way Dalbar found happened repeatedly in 2024. None of this makes investors careless or foolish. It makes them human. Theo was not failing at investing. His brain was responding in a completely ordinary way, treating a flat stretch of month as a warning sign instead of unremarkable weather. This is exactly the gap the 9751 rule exists to close, not through some clever edge over the market, through taking the self-defeating choices off the table before a person even gets the chance to make them. Now let's follow Marcus all the way through. He starts at $500 a month. He gives himself at least 7 years before he allows himself an opinion about whether it's working. His money gets split across all 5 layers, not parked in one idea. Every year on schedule, his contribution ticks up by 5%, quietly enough that after a while he stops noticing he's doing it. By age 37, 7 years in, his balance sits around $66,000, a bit higher than the number from a few minutes ago, since this version of Marcus has also been adding that 5% a year on top. He is not at the finish line yet. That is still 3 years out. But he is close enough now that quitting here would mean giving up right before the reward. By age 45, he is sitting around $250,000. By now, the market has been out-earning his own contributions for 5 straight years. Ever since he turned 40, it has stopped feeling like a fluke. It has started feeling like the norm. By age 55, his balance is close to $860,000. His habits have not changed since he was 30, not once. Only the scale of what those habits are producing has changed. By age 65, assuming he never stopped, Marcus is looking at somewhere around $2.5 million. He contributed a little over $500,000 of his own money across those 35 years. Compounding added almost $2 million on top of that. In just the final 10 years, his balance grew by well over $1.5 million. He personally contributed only a fraction of that in new deposits. His money by the end did more of the work than he did. Back to that phone call, Marcus staring at $20,000. Theo, on the other end, quietly explaining that he stopped because nothing seemed to be happening. Theo was not lazy. He was not careless. He simply landed in a quiet, uneventful stretch and mistook it for the whole story. Nobody had ever shown him there was a specific point on the timeline where things change. So when the numbers looked slow, it felt reasonable to walk away. Here is what that pause actually costs in real numbers. Theo, letting his first year ride untouched for the next 34 years, reaches age 65 with roughly $132,000. Marcus reaches age 65 with close to $1.5 million on this flat comparison, or the $2.5 million from a few minutes ago, once you layer his real step-up habit back in. But here's the part that should sit with you. Now apply the 5% annual step up to both men, with Theo restarting after his 2-year pause and catching up to Marcus's current contribution. Letting his first year's money keep growing right alongside the new contributions, he still finishes about $250,000 behind at age 65, purely because of 2 quiet years already gone. Marcus is not sitting on $20,000 or on track for 2.5 million decades later because he was smarter than Theo or luckier. He just kept showing up long enough to reach the part that moves on its own. That is what the 9751 rule protects you from. Not bad investments, not market crashes. Quitting at the exact moment quitting feels most justified. Each number is simple on its own. Together, they take the decision out of your hands on the days you're least equipped to make it well. Picture yourself 10 years from now. In one version, you're still checking your account occasionally, still unsure whether any of this is real. In the other, you've long since crossed your own invisible finish line, and checking your account has become one of the better parts of your week. The only difference between those two people is not talent, it's not luck, it's simply whether you stayed invested long enough for the math to turn. So here's the actual homework, and it starts today, not next week. Pull up your account. Find the date you actually started and hold it up against the number 7. Be honest about the distance between them. Scroll through what you own. Count how many of the 5 layers are actually represented, not just the one you happen to pick first. If you're just starting out and only have enough for one layer right now, that's completely fine. Layer 1 alone is a reasonable place to begin. Just don't stay there once you have more to work with. Then open your settings right now and schedule a 5% bump to your contribution. Time to land on your account's next anniversary. Setting all of that up takes a few minutes. What it builds will take years to show. It builds anyway, whether you are watching or not. Quick disclaimer before you go. None of this is personalized financial advice, just a walkthrough of publicly available research and general education. What you do with your own money and how it turns out is entirely down to your own choices and circumstances. That's the whole pattern, laid out in 4 numbers. Following it is the only hard part left. Subscribe if you want help doing exactly that, one video at a time.